Well, hello again. Welcome back. Last week we talked about discipline, limited decisions, margin of safety. But there's something we haven't clarified, something that confuses almost every investor. Price and value are not the same thing. Section 1. The fundamental distinction. Let me be crystal clear about these two words. Price is what you pay. It's the number on your screen. It changes every second. It's whatever people are willing to pay right now. Value is what something is actually worth based on the profits it will generate in the future. It changes slowly. It's based on business fundamentals, not emotions. Most investors confuse these constantly. They see a price and assume it equals value. It doesn't. A stock can trade at $100 but be worth $50. You'd be overpaying. A stock can trade at $50 but be worth $100. You'd be getting a bargain. The stock price is just a number. The business is what it is. Section 2. Case Study 1, Apple 2008. Let me give you a real example. Apple in 2008. The financial crisis had hit. Stock market crashed. Everyone was panicking, selling everything. Apple stock dropped from $180 to $90 in months. The price was cut in half. Now, most investors thought, Apple is now worth half what it was. It's declining. Avoid it. But that wasn't true. Apple's business hadn't changed. Steve Jobs was still there. The iPhone was still revolutionary. Profit margins were still strong. Customers still wanted iPhones. The business value hadn't dropped 50%. The price had. Smart investors saw this difference. They asked, did Apple's profits decline 50%? No. Did the product get worse? No. Did customers stop buying? No. So they bought. By 2010, Apple stock was back to $250. By 2015, it was at $600. By 2024, it was at $220. Wait, let me be accurate. By 2024, adjusted for splits, it was over $220. A patient investor who bought at $90 in 2008 when everyone was panicking had turned their $90 into $220 plus by 2024. That's a 244% return in 16 years. But only if they understood one thing. The price had dropped. The value hadn't. Section 3. Case Study 2. Pets.com, 1999. But here's the flip side. High price doesn't mean high value. Let me tell you about Pets.com. 1999. The dot-com boom. Everyone was excited about the Internet. Any company with .com in its name seemed like it would make billions. Pets.com's stock soared. Price went from $5 to $14 per share in weeks. Investors were euphoric. This was the future. The company spent $11.8 million on advertising in 1 year, but they made only $619,000 in actual revenue that year. Let me repeat that. Spent $11.8 million, made $619,000. The math is simple. You cannot build a profitable business that way. But investors didn't care about the math. They cared about the price. The price was rising. That's all that mattered to them. By 2000, Pets.com filed for bankruptcy. The stock went to zero. Investors who bought at $14 thinking it was worth that lost everything. The price was $14. The actual value was zero. They were completely disconnected. Smart investors, the ones who did the math, saw this immediately. Spending $11.8 million to make $619,000, this is insanity. Price is completely disconnected from value. They avoided it entirely. Section 4. How to estimate value. So how do you estimate value? How do you know if price is cheap or expensive? It's not as complicated as Wall Street makes it sound. First question, how much profit does the business make per share annually? Let's say a company earns $5 per share in profit. That's cash the business generates. Second question, how fast will this business grow? If it's a stable business like Coca-Cola, maybe 5% annually. If it's a growing tech business, maybe 15% annually. Third question, what multiple of earnings should you pay? Here's the key insight. The multiple you pay should roughly match the growth rate. Why? Because faster-growing businesses are more valuable. You can afford to pay more for faster growth. If a business grows 5% annually, you pay around 10 to 12 times earnings. If a business grows 15% annually, you can pay 15 to 20 times earnings. Let me give you two examples. Example 1. Coca-Cola earns $5 per share, grows 5% annually. Fair multiple, around 12 times earnings. Fair value, 12 times $5 equals $60 per share. If the stock trades at $40, you have a 33% discount. Buy it. Example 2. A growing tech company earns $5 per share, grows 15% annually. Fair multiple, around 18 times earnings. Fair value, 18 times $5 equals $90 per share. If the stock trades at $60, you have a 33% discount. Buy it. Same earnings, same valuation discipline, different multiples because growth is different. Section 5. The psychology. Now, here's why most investors can't do this. When everyone is panicking and selling, like Apple 2008, the price feels dangerous. Your brain screams, "Don't buy, it's falling." But that's the moment value is highest and price is lowest. Conversely, when everyone is euphoric and buying, like Pets.com 1999, the price feels safe. Your brain screams, "Buy, it's going up." But that's the moment price is highest and value is lowest. The successful investor does the opposite of what feels right. When price is low and value is high, they buy despite fear. When price is high and value is low, they wait despite FOMO. This is why discipline matters more than intelligence. An average person with discipline beats a genius with emotion. Section 6. The principle. So here's the principle. Value equals business earnings times appropriate multiple for its growth rate. Price equals what people are willing to pay right now. When price is less than value, buy. When price greater than value, wait or sell. When price equals value, it's neither cheap nor expensive. The entire job of an intelligent investor is comparing these two numbers, nothing more. If you can master this one skill, understanding the difference between price and value, you'll outperform 90% of investors. You don't need to pick winning stocks. You need to avoid overpaying for any stock. Next week, we talk about something critical, how to recognize which businesses actually have durable value. We talk about competitive advantage. We talk about the moat. But before we go, if this is helping you think differently about investing, please subscribe. Hit the bell icon. Subscribe. Share this with someone who needs it, and I'll see you next week.